Okay, so if this is your first presentation, who are we? Rand Swiss, I founded the business in 2015. I used to be on the Vunani trading desk. Since then we've kind of racked up a whole lot of industry awards, which is really great. The Intellidex Stockbroker Awards is the kind of premier measurement in the industry. It's all the big banks compete in it. You've got Standard Bank, ABSA, FNB, all of them are represented. In 2019, we were honored with the overall top stockbroker award. We also won top advice broker, and we won the People's Choice Award. So that was from the client base voting for us. Last year we came second. Standard Bank took the first place, which, I mean, guys, they've got a much bigger budget than us. So we do as much as we physically can, but it is difficult competing against one of the big four banks of the country. But yeah, they have an amazing team there as well. But we did win the best online broker through our technology partners. And obviously we structured a tax-free savings account last year, which was basically an incredibly low-cost tax-free savings account, which we're basically running as a loss-leading product to introduce our services to the world. So we won best tax-free savings account last year as well. The new awards are coming up now soon, so they're about 3 months away. So we're going to kind of start prepping anyone that is a client, just kind of like asking questions, seeing what we can fix, and kind of putting all the polish on before they come and test us, because these awards are very, very onerous. We get mystery shop. There's about 3 or 4 different ways in which we get examined for them. So and obviously we always want to do well. So any positive feedback during the awards is very useful. And any negative feedback is great, just not on the questionnaire. But please give it to us so that we can improve the business, of course. What do we do? So I kind of touched on it in the beginning as well. We've got kind of the spectrum, which is the first three parts of our business, which is the online trading, which is very much self-directed traders. We have very little interaction with the self-directed traders. It's very much this kind of communication where it's one person speaking to many people. You guys are really doing it all yourself. We normally do for smaller accounts. We really have to unfortunately leave you. We don't have the ability to give everyone private client service. But if your account is of a reasonable size, we normally do an introductory meeting with you, teach you how to use the platform. But then still, we get your ship ready, but you're sailing this thing. Then obviously, if you have enough money in the account at the moment, we've had to move it up to 5 million rand initial fee, just because of the volume of work and the volume of new clients. So the private broking starts at a minimum account balance of 5 million, and there we really can give you full service. So there, you're still making the decisions, you're telling us to buy and sell, but we can give you all the support around research. You can ask us questions. We can do all that kind of like fun stuff that the old school broking was about. Kind of spending a lot of time on the telephone to clients. Hearing your views. Sharing our views as well in a much more personal one-on-one space, which unfortunately the online trading book just can't get. They have to get this one-to-many communication. Managed portfolios, what we're talking about today, this is where you guys, again, you kind of give us the money, we manage, and you're really just looking at the performance. Structured products, what Verve runs, kind of a nice medium risk product. It's basically you take on counterparty credit risk, but we vary them across Citibank. We've just closed a product with Citibank Luxembourg. It was really cool product. We're looking at launching the next one. So we've got a couple of third-party products that are out at the moment that we'll start discussing with everyone. We've got one that we've built ourselves. We're just getting final compliance sign-off to it, and then we'll launch it into the base. So you should get an email about it if you're interested. I'm sure Verve will do a webinar around it just to explain the ins and outs. It's basically going to be a worst of the European indices. It's going to give you about a 15% dollar-based coupon. So we're really excited about that. Offshore Transfers, that's just a subsidiary business that feeds all the other business because we work internationally. Wealth management, as I say, Yak is kind of our wealth guy. And tax-free savings accounts, which is, we kind of put it as separate, but it's a product that really is a building block. It's really your first, what I think of it is anyway, is your first step in investing. Everyone should have a tax-free savings account. If you don't, you're really just not doing things correctly. So that's who we are. What we're going to do today is just global market overview, go commodities, currencies, and the global managed portfolio as well. So what has been happening over the last month? Yeah, South Africa, man. South Africa is really just absolutely shooting the lights out at the moment. So I put out a tweet a couple of months, it was about a month, maybe 2 months ago. So, yeah, it was on the back of prep for one of the previous things, just saying like South Africa has performed, over 1 year, we were the best performing market by about 20%. Obviously, rebase the dollar, this is base 100, everything converted into dollars. So you are comparing apples with apples here. This is the financial market performance of the leading indices in all the different countries. And in dollar terms, we are absolutely flying. Now, it makes sense. The currency is really, really strong. But even with the currency being as strong as it is, the underlying companies are performing really, really well. It's one of the things that Crystal on our desk, when we're kind of chatting about, we always chat about these things as we go through the trading day, and it's kind of a known fact that Richemont should be a rand hedge. So if you expect the currency to blow out, you'd buy a company like Richemont because just about all of its assets are international. Like there's almost no. It's got a listing in Switzerland. It's totally outside of the South African jurisdiction. It's very uncorrelated, can I say, to the GDP of South Africa, if you want to put it that way. And yet, as the currency has just strengthened, which we're going to look at in the currency position, Richemont has been shooting the lights out. It really has just been going up and up and up. Now, the point is, the rand has actually been taking some of the shine off Richemont's local listing. That stock should have been coming down, but the underlying asset that is Richemont is just performing so well, even in dollar terms, that it's more than compensating for the stronger currency, which I think is also an important theme that we should explore today. The idea that, yes, we have a stronger currency, and especially because a lot of these portfolios are offshore. But if you're invested in the right things overseas, a stronger currency is really nothing to worry about. It's an opportunity to move potentially more funds out at a great level. But it's something that I'm going to do a separate presentation just around this idea, that if you are investing, if you are looking at offshore versus local, and like I said, this is a very much an offshore focused discussion today. But if you're looking at offshore as just because I'm offshore, just because I'm in hard currencies like euros, dollars, pounds, that means that I'm safe and that my money is going to beat inflation. That is South African-based inflation. That is a very, very bad way of thinking about investments. So cash is always supposed to be a parking spot. Now, because inflation is technically lower or at least it has in the past been close to zero in a lot of developed markets, your money in euros, dollars, pounds, it will, francs, if you're so inclined, will lose value more slowly than in South Africa. And it's one of the reasons our interest rates are higher, so that you can essentially keep pace with inflation in a money market account in South Africa, and they don't have to give you much interest overseas for you to still keep pace with inflation. It's just how interest rates and inflation are very, very linked. But the fact is that if you're sitting in dollars and pounds, it might be your capital might be eroding more slowly, but it is still eroding. And if you've got local liabilities, if you live in South Africa and you were just hoping that dollars are going to be the answer, it really isn't. I mean, you've had to invest the money, and if you did invest the money, you are smiling. You really, like, the stronger currency is nothing to worry about. So that's the kind of thing. I want to do a whole different webinar around that, and that'll probably be in the next month or so. But looking at the performance, I mean, we are killing it, man. Up 8% in dollars over the last month. Now, this actually goes so this goes to until close of business last night. So it's not the exact calendar month. It's just the 3rd to the 3rd. Italy doing well, Canada doing well, France doing well, UK doing well. You can see a lot of the European counters also lifting. Germany doing well. Japan is always a bit flat. I mean, Japan's got demographic problems, so we don't see the kind of big swings. It's also, the yen is a safe haven currency, so you don't see the kind of swings that you see in some of the other, like certainly the emerging markets. US slightly on the back foot this month, down slightly. But and China again bringing up the rear. So the last 3 months we've had China under all sorts of pressure, and I don't know if you saw the news announcement last night. Biden has come out with 59 countries that at least 59 Chinese companies with military links that they are putting on the US blacklist. So US investors are not going to be allowed to make investments in the Chinese markets. And while we had obviously the trade, the Sino-US trade war under Donald Trump, and the idea that Biden was going to unwind it and potentially be more friendly towards China and more aggressive towards Russia, whereas Trump was seen more friendly towards Russia and more aggressive towards China, doesn't seem to be playing out. He seems to be very, very, set on, especially in terms of kind of the corporate and industrial espionage, especially with any company that has ties to the Chinese military. The PLA, it's a problem. So, we have kind of one, which is Alibaba, but we've actually had good news out of Alibaba recently because obviously Jack Ma's financial concern is actually being given the go-ahead by Chinese regulators. It's actually been the Chinese that have been the regulatory problem around Alibaba and Jack Ma's various businesses ever since he went missing, if you remember that story. They have escaped. They're not on the list. Neither is Tencent. So those two are safe and sound. But the likes of Huawei, so the Huawei phones that we use, the US are not allowed to invest in Huawei as a company. China Mobile also off the list. Also there's a large semiconductor company as well that's on the list as well, which is obviously with the big chip shortage that we're seeing in the world at the moment, that is an input to the likes of Broadcom and a lot of the big chip makers. So how that pans out when Americans are not allowed to invest, and there's all sorts of other regulations around trading with these businesses, I think it's going to be interesting for China, and that concern around direct regulatory action from the US and kind of the way that the US is going about it, I think is putting a lot of pressure on Chinese markets. And we've seen them heavily on the back foot over the last couple of months. So if I go to, this is just a 1 year performance. Whenever I put these performance charts up on Twitter, people go, oh, but what is 1 year? What is 1 month? It's because we do this event once a month. So I do a monthly, let's go and look at what we're doing for the month before. And the year is to give you context. We're going to look at some longer term charts in a bit anyway. But as you can see, South Africa, over the last year, obviously coming off a lower base after coronavirus, but absolutely pumping, just like shooting the lights out there, up 55% in dollars over the last year. If you had stuck your money into the markets a year ago, these numbers are, as I said, going to kind of contract as we do these presentations month in and month out, because of course, you would have been buying in a dip if you bought exactly a year ago, because you would have been buying in the height of coronavirus panic. But you can see over the last year, China has been under all sorts of pressure, even underperforming Japan. And that is an issue. And part of this is from Chinese regulatory things, and as I said, part from the US as well. Canada recovering nicely, but Europe also doing well. US kind of mid-table. So France and Italy doing a little bit better than the likes of Germany, but we are building, we've actually building, it's built, and we're starting to execute like a beta execution. So we're putting our seed capital into it at the moment so that we can get our track records, which we match model portfolios to a European portfolio. And I can say, out of all European destinations, the kind of quant scans that we run and the way that we think about investing in terms of how revenue is growing and kind of like the professional analyst community's consensus view of where the value is to be had in Europe, it's very much French and German markets. That's really where the exciting companies are. We've got it's going to be a 10 stock portfolio. It's almost a smart beta portfolio. The 10 best stocks of the Euro stocks. Just finished building that. We'll launch the clients probably in the next 2 weeks. Like I said, we're busy implementing the seed capital at the moment, and then client capital can follow after that, which will be very cool. But yeah, so I think there's opportunity in the European countries, but seeing a nice lift in performance. Obviously, we are in the model portfolio, the portfolio that this webinar is specifically discussing at least, very invested offshore, and what at least in the US. So this is just the S&P 500 heat map, showing exactly what's going on in the US at the moment. A very mixed bag. It's gone from the last couple of months we've had kind of mixed ones, and then we've had some that are just an absolute sea of green. We're kind of getting into May now, which the old saying is sell in May and go away. Maybe it's going to work, maybe it's not going to work, but definitely we're seeing slightly more subdued returns this month in terms of the US market. As I said, the whole US market was actually slightly backwards, but you can see where it's coming from. A little bit down in the likes of Apple. We don't hold Apple. Google up. Google continues. It continues to rank. When we run our quant scans, it comes up top 2, top 3. Consistently. Like there's still in our opinion a huge amount of value to be had in Google. Amazon a little bit on the back foot. We're looking at it as a buying opportunity. I did a nice article. We're going to talk more about Amazon later on. But I think a buying opportunity on Amazon. You're seeing some of the more expensive stocks that we saw in the run up last year, and kind of that frenzied, almost like Wall Street bets driven trading, excitement coming off. So we've got Tesla down around 15% in dollar terms over the last month. There was a lot baked into Tesla stock. There's nothing wrong with the fact that they're rolling out electric vehicles, and it's a very exciting business, very fun to follow. But it was at a very, very high valuation, and I think they're looking at delivering about 750,000 vehicles this year. I think that's what, 750,000, yeah. And so they're still growing, they're improving, but they were always priced for absolute perfection. So that's not coming under a little bit of pressure. I'm still seeing, some positivity in the banks as well, likes of JP Morgan, which we hold in the portfolio, up 7% over the last month. Bank of America up 5%, Berkshire up. So a little bit of a switch towards value, which I think we talked about that last month. We've kind of chatted about it with a lot of clients. Happy to see CRM, my new position, which is kind of a tech position. They had spectacular results. We really want to be invested in them. We kind of got in a little bit on the hype, so it's been kind of dragging a little bit in the portfolios. But nice jump this month in that as well. Oil and gas still looking very good, but we'll talk about oil and gas under commodities. What's the big news today, and what's happening in the US market, which, as I said, most of our positions are focused on the US market. While they do have geographic scope, a lot of the companies, they are linked to how the US is performing. Now, interestingly, this is just a continuation. We kind of do a dashboard every month just of what's going on. So we can see we were concerned that inflation it was pushing up. So when we got remember we get the April numbers now. So April inflation, April unemployment get reported in May, and we'll only get the May numbers obviously later in June now. But we can see that inflation in the US is picking up in a big way. Part of this is the higher commodity prices and the higher oil prices specifically. So if you take core inflation, which strips out food and energy, that inflation number is a lot lower and a lot more stable. But higher commodity prices are feeding into the inflation number, and you can see we are now well above the Fed's target rate of 2%. Remember, there's different ways of measuring inflation. So this annual US inflation, this is a CPI number, so the Consumer Price Index number. And the Fed actually looks at PCE, so personal consumption expenditure. Subtle differences, but they both measure inflation. When CPI goes up, PCE goes up as well. Maybe it's slightly different degrees, but the point is inflation is rising in the US. If inflation rises, interest rates will follow. We've also just while I'm thinking about it, we've also got a new account from Investec that we're putting out called the Prime Money Call accounts. Very cool accounts. You're probably going to get a mailer. I think they've got a schedule to drop on Saturday. So I would encourage anyone that's sitting in our CCM accounts that they were the best money market fund accounts in South Africa, where you could access cash on call. Obviously, with a falling interest rate, that's wonderful because your rate actually lags behind the interest rate, which is cool because the Reserve Bank cuts interest rates, and it takes a few days for your interest rate to come down, or even up to about a month. Then they cut again, and then your interest rate is still elevated. So you're kind of getting the drag the other way around. The Prime Money Call account works the other way around. So now if the Reserve Bank hikes through interest rates, which we expect them to do this year, probably in November, your funds will immediately get that extra 0.5% or extra 0.25%. There's no lag on the way back up. As well as that, they're offering 4.3% at the moment, which we've compared them to Discovery Bank, we've compared them to all the major banks, and everywhere we can look. I cannot find a call rate that's even within probably 0.5% to 0.7 maybe. percent of this interest rate. So it's a really solid account. I think Investec was seeing a lot of flows leaving the bank. So they've come out with a very competitive product, which we're going to say. So if you have a CCM account with us, I would just say to you, like, just get hold of your dealer, get hold of whoever you chat to, send an email to info@RandSwiss, say, I want to switch to the Prime Money call account. Like I said, we're going to send out mailers over the weekend probably, but it will either be the weekend or early next week. When you see that, if you've got a CCM account, just ask them to switch, because you're going to get the higher interest rate, and it'll be better for you when the interest rates start rising. That's a separate matter. Back to the US. Okay, so inflation is rising. The Fed still says this is transitory. They say the supply chain disruptions we've seen from the pandemic and from COVID are really the reason that inflation is as high as it is, and it's going to be, their word, transitory. There was a drinking game on Bloomberg about this. So every time the Jay Powell said transitory, you had to take a shot. Yeah, so it's kind of a bit of a joke around the industry. But yeah, 4.2%, it's too high. It's way too high. Now, the point is that if inflation keeps rising, we're going to have to see an unwinding of this ultra loose monetary policy. And what kind of, I think, has put it, so we still haven't had any signals from the Fed, or very few signals. There's been a couple of Fed officials from kind of like outlying divisions, and not kind of prominent guys, saying that they think that there's a risk certainly in asset price inflation, and that they would consider tapering. But the official stance of the Fed is no tapering of their bond buying program just yet. I think what's also helped that is if you look at the unemployment number, you can see that we actually have a reversal in unemployment. So unemployment was coming nicely down after the kind of spike out over the pandemic. We got to 6% US unemployment rate, and then last month, so when we got the report in May, printed at 6.1. So that's actually reversed for the first time in a long time. That reversal is very important. The non-farm payrolls number, which is the big US jobs number. Remember, there's so many jobs numbers. You get initial jobless claims every week on a Thursday. You get ADP as well just before. It's normally the Wednesday before. It was yesterday. ADP came in about 1 million jobs added yesterday. A very, very positive number. Beat expectations. All these numbers kind of point to how strong the US labor market is. But last month, the big one, the non-farm payroll number, missed in a big way. As you can see down at the bottom here, the non-farm payrolls is the top number here. Last month, I mean, they only got 266,000 jobs added, which is absolutely tiny. It was a big surprise. The prediction today is 650,000 jobs added. We've got all sorts of side bets going on in the office. There's a whole wall written up with everyone's saying. I personally think it's going to miss again on the downside. I think that you're going to have stimulus a little bit longer. I've got my number up at 420,000, but it's also just for a bit of fun. Doesn't really influence our thinking too much about longer term equities, but it's something that we've got to keep an eye on. And yeah, so we'll get what the unemployment rate has moved to today. The prediction is for it to drop back to 5.9. So they're basically saying that April probably was a blip. I also personally think the reason I've gone low this month is I think that we're going to get a big revision up from last month. So I think that anomaly of 266,000 is going to be revised up. I think the numbers are to 230 today, so we're going to find out after the webinar. But that's just to give you a little preview of the numbers. Minimum estimate 400,000 jobs added, maximum estimate 1,000 jobs added, and obviously with the tools that we have to kind of look at markets. This is the Reuters system that we're using. So that was the Icon system. It's now called the Refinitiv system. Actually, they keep changing its name. We've got all predicted smart estimates and things that will help you kind of make better calls. Whether they work or not, is debatable, but yeah, lots of fancy tools that we get to play with. But that's going to be an interesting number, certainly, and then I'll give you guys more feedback next month on what happened and how it's influencing the US economy. So, of course, the other big news event in the world is the coronavirus and vaccines, and how many cases are there and what's happening in the world. So instead of doing anything, I mean, like I said, the coronavirus, I think, is here to stay. We have vaccines. The vaccine rollout is going well in most of the developed world. We had Europe lagging in a big way when they started their rollout, but I remember Viv saying in one of his presentations that he just cannot see. Europe might have blundered the beginning of the vaccination run, but he can't see that continuing. They will catch up quickly. I believe they almost have caught up with the UK now. So Europe is, from a vaccination point of view, has really got its act together and turned things around. Most markets, so India was the big concern. I mean, I'm sure you've seen the horrific footage of what's happening in India. But fortunately, looking at coronavirus cases, that caseload, their wave is kind of ending at the moment. So that's coming off. Israel, which was always the bellwether for how well vaccines were going to work, we've seen no spike. We did get news that there was a new double variant from Vietnam that broke on Reuters about a week ago. It was kind of a mixture between two variants, but like I said, apparently it was airborne. That was the headline. But I think coronavirus, from a financial market point of view, is in the rearview mirror. It's something that I don't think is going to go anywhere. I think it is going to change the way that we live. But with vaccines, I think it's going to become like a flu shot. You're going to have your vaccine regularly, and hopefully the globe builds immunity. Because the idea of going into those hard lockdowns where we are literally not allowed out of our houses, and we're walking around Woolies with tape across the clothing, and I can't see us going back to that crazy lockdown. I don't see it happening unless there's some sort of crazy mutation. And even in South Africa, we've obviously been moved up. We've had our family meeting. We are going into our third wave. So you can see, I saw a lovely chart. I couldn't find it for this presentation, but just overlaying the three kind of trajectories of increasing caseload based on date. And you can see we basically doing exactly what we did in the last two waves. In this third wave, it is starting to increase. So it's coming. It's real. It is something that we've got to be concerned about. The US obviously accelerating with the vaccinations. Biden's got his big target, Independence Day. He wants independence from the virus, and so I put that in. It's an interesting. I saw an article. It's actually from MarketWatch. Biden promises free beer and childcare if 70% of Americans get at least one vaccine shot before the 4th of July. And the fact is that, we've kind of been discussing it in our investment committee meetings, like, numbers, and I kind of chatted about it last month, how numbers flatten out in the coronavirus because there just are anti-vaxxers out there. There are people that will not take the vaccine. And that means that you're never going to get to 100% vaccinations, but 70% we deem as pretty high. And it's because they're putting in all sorts of ways to all sorts of incentives. So this free beer and childcare is basically like they've got basically childcare companies that will look after your kids while you go get the vaccine. They've tied up with AB InBev, so the overseas thing we've got it on our local exchange, but overseas particularly is Bud. To essentially offer free beer as an incentive to go and get a vaccine. So they're doing all sorts of things to try and just campaign to get to that 70% vaccination rate. And like I said, with the people accepting the vaccine, with the technology that we've developed around vaccines, I think we can assume that the kind of hard lockdowns are a thing of the past. The world has changed. There's no question about it. We're not going through another big market slump because of it, in my opinion. Unless unless we all start bleeding out of our faces or something because of a proper mutation that joins with Ebola. I don't know. I don't know much about biology. I know about numbers. So 2 billion doses, 1.2 billion were previously chatted to you guys about it. We've now got almost, we're getting towards 6% of the global population has been vaccinated. So the vaccines roll on, is what I'm saying. So how does that relate to economics, and how does that relate to portfolios and investments? As I said, I think there's been so much jostling, vaccine stocks versus not vaccine stocks. It's time we found the next thing, man. Like, I think it's going to be value versus growth, to be honest, is going to be the next big talking point. But as I think these commodity prices, inflation picks up. But this is numbers from the OECD, just looking at the number of years that it's going to take for per capita GDP levels to return to pre-pandemic levels. I've got bad news for South Africans, unfortunately. It's us and Argentina, man. Like we are there at like 5 to 6 years. That's kind of where we sit in South Africa and Argentina. It's going to take a long time for the economy to catch up. Now, remember that the economy and financial markets they absolutely interlinked, but they are very different. So financial markets are a leading indicator of economics. So while, yes, we understand it's going to take a while for these numbers to pick up, financial markets are already pricing all of that in. And we've got to be looking further out than that if you want to try and predict what financial markets are going to do. But I thought I'd share that little chart with you as well. As usual, we normally look at the VIX. So volatility, not too much. Like I said, the idea that we're going to go into this kind of like absolute panic, which VIX is also called the fear and greed index. It's volatility on the Chicago Board Options Exchange. Kind of still tracking high. We're still not at those levels, which is still making those kind of traditional structured products a little bit more expensive because the vol in the options is pretty pricey. But weirdly, that's why we're kind of creating these auto calls, because auto calls actually work the other way around. You can actually benefit from the vol, which is where we're getting the nice pricing. How we can get 15% in dollars off that was a Citibank note as well, 15% in dollars. Okay, it's simple interest, but 15% in dollars per year with, I think, 30% capital protection. Okay, and you're taking on Citibank credit, Citibank Luxembourg's credit, but it's a nice product, which you're going to hear more about that in a bit. But that's kind of where volatility is. Markets are still very nervous. And I think from an equity point of view, because we're talking about equity markets and equity portfolio, my feeling is that markets are probably too nervous at the moment. And it's the idea that, it's the idea Yapi from Investec, who's on their structural product division, always uses the example as explaining how volatility works and how option pricing works. And I think about it like an option is like insurance. And the pricing of the option depends on volatility. It depends on what's happened recently in the memory of kind of the calculation. So when you get a huge spike out like we've had here, in the memory of the calculation of the volatility, is the spike. It's saying, wait a minute, this can happen. When that hasn't happened for a long period of time, the calculations price that out. So think about it like this. It's, if you go to an insurance assessor and you say, I've got a barn sitting on my farm and it hasn't burnt down in 50 years, how much will it cost to insure it from burning down? Your premium is going to be very, very low. They're not going to ask for much money. Hey, it's been around for 50 years. It's not going to burn down. But if your barn burnt down 3 days ago and then you built a new barn and you say, can I please insure it? And they say, when last did you burn down a barn? Oh, well, it was 3 days ago. Well, then suddenly your insurance premiums are a lot higher. And the point is, we've had very flat markets we had a 7-year bull run. And nothing happened. But then we had the pandemic. It was such a left field. It was a tail risk event. And the point is, the chances of the pandemic happening again in this thing and being the reason that markets fall, I think, are incredibly slim. The chance of another big event happening are pretty good, but it'll happen as market cycles normally happen. And when they do, it'll fall, and the world will get together and we'll solve the problem, whatever the problem is, whether it was a global financial crisis, whether it was the pandemic, whether you go further back to kind of the Asian crises. These things work their way through the system. But when you're pricing just after that, because it's so recently in the calculations, your natural tendency is to assume that risk is more prevalent than it is. And in that way, I think a market has, people are getting it wrong. And honestly, while stocks are high, I think that you're going to be surprised at how much higher they're going to be in the next 5 years. That's my opinion. I don't see like a significant pullback. 10%, 15% corrections happen all the time. Great opportunities to get in, but longer term, I'm talking 5 years, I think we're gonna see very decent returns from the equity market. Think of what happened after the Spanish flu, went into the roaring 20s. Why so good? When you go through an economic shock like this, you cut out the dead wood. All the companies like Edcon, they shouldn't have been, they were stumbling along, but because times weren't that bad, they were surviving. the really poor companies got taken out. That frees up resources to go in. It's the creative destruction element of capitalism that allows really solid businesses to make it through, and the weak ones fall away and they have to reinvent themselves as something better. That's what drives performance. It's like, I think, a lot of farming metaphors today, or similes, like, you burn a field and you burn a field, then all the good nutrients go in the soil and it grows back better. That's what's just happened. So I think much higher markets in the next 5 years. So I would still be, in my opinion, and okay, I'm talking my book, but I would think equity markets are the thing. Sorry, I joined late. What is the opinion on gold and platinum? Okay, cool. I'll cover gold and platinum in the commodity section or currency section, because I kind of think of gold as more of a currency. And platinum is, that's a commodity. So we'll talk about that in the next section. So this is kind of my little stock thing for today. I've got quite a lot to say about this, weirdly. So, okay, Disney. Okay, so Disney sits in our portfolio. Disney is like the blue chip of blue chip media companies, but it reported this month, so I thought like it's probably a good time for us to include it in the discussion. So I need to get your chat window out of my way so I can see. So this is just kind of like general news flow. So they reported earnings on the 13th of May. It was kind of mixed, and the market has actually recovered off the back of them, even though it missed expectations. So it beat on earnings, but it missed on revenue. Now, why did it miss on revenue? So people, I think they were a little bit more optimistic. It seemed like the analysts underestimated how much revenue was being generated by the park. It's not by ticket sales into the parks, but just the whole, the whole ecosystem that is Disney relies on those parks, from secondary merchandising to all the kind of other you go to a Disneyland or Disneyland Paris or whatever it is, and then suddenly you get that happy Disney feeling, and then you go and do more stuff. You go and buy Disney clothes, and your kids love Disney. Like they underestimated what the impact of shutting the parks was going to be on the overall business. So they saw revenue down quite significantly. But that really wasn't the story of the earnings to me, and it's not the story of why we own Disney. So the parks businesses are wonderful. I mean, owning theme parks and having a little bit of hospitality and leisure, and certainly picking up hospitality and leisure when you are, when you've got a shock like this and things are more reasonably priced. So to pick up some blue chip stuff when it's down, great. Disney's the one to go for. But that's not the story of Disney for me. The story for Disney and the future of Disney is as a content creator, and it's really their streaming services and their media. So just to kind of put it in context, their media networks account for about 40% of their revenue. The parks account for 23% of their revenue, 13% from studio entertainment, direct to consumer like merchandising, etc., 23%. Most of this, as I said, this is the reason that we go through the US numbers, is this is a US business. Like, so while we have, I'm sure you can go and buy Mickey Mouse pajamas in South Africa, I'm sure Disney gets a royalty for it. And while I'm sure you watch Disney movies in South Africa, it's the big money is coming from the US, which is almost 80% of its revenue is US based. So the recovery in the US and what you're doing when you're investing offshore, and it's something that we can talk about later, but you really need to think about is, why am I invested offshore? Is it to get diversification? Is it to get access to these other people to benefit from their economic activity? That's what you want, and that's what you're getting in Disney. So as you can see, I've just got a revenue and earnings on the right-hand side. I'm going to tell you the story of Disney in a second, but revenue and earnings, you can see obviously earnings collapsed. And I mean, remember what happened is, and it was always, I've kind of spoken about it before, it was one of the big concerns that we have in the portfolio. So I was like, okay, listen, they're shutting the parks. This is a big deal. What are we going to do? And we looked at it, and it just, the way that the American system works is awesome. They just retrenched everyone. South Africa, you can't retrench anyone. South Africa, the private enterprise has to do the job of government. In the US, the system functions. The government is smaller and the rules are more in favor of business. So what the business can do is they'll pay their taxes, so the government has money. The government isn't corrupt, so it doesn't steal the money. And they can just retrench all their staff. What happens? The staff get retrenched. They don't hate Disney. They understand. Well, Disney can't operate. We're in COVID. Our parks are shut down. This is a problem. So they get retrenched, but the government can afford through taxes to pay these people, their stimulus checks. They manage to get it, and then when they get through the pandemic, Disney is still in solid shape. The business is still great, and they can hire all those people back. Those jobs aren't lost. South Africa, a little bit different. We put all the pressure on the companies. The companies close down, the jobs disappear. We get back from the pandemic and go, where are the jobs? Which is probably, if I had to go back to the OECD chart, why we are going to take 4, 5, 6 years to recover versus the US, which is going a lot quicker. So a lot of this comes for me down to systemic policy, but that's a side thing. Anyway, back to Disney. So you can see obviously earnings collapse, but we're seeing a quick rebound in earnings as well. Revenue also kind of ticking up. Now, I said this is not why we own Disney. So why do we own Disney? Disney for me is it's all about their Disney Plus and the Disney streaming. So one, it's the content library that they have. But it really, for me, Disney could easily take on the likes of Netflix. I don't know if it's going to be able to take on Amazon, but that's what I wanted to kind of just compare for you guys. So obviously the last 5 years, the place to be if you're looking for streaming entertainment is definitely Netflix. Netflix has had the, through its subscription model. I mean, remember, Netflix started out as like kind of you post the DVD comes back, so you don't have to go to the DVD store, and then it turned into this digital network. So 5-year CAGR, so if you don't know, CAGR is compound annual growth rate in revenue, so it's sort of what their sales are as a business, 83.76% for Netflix. I mean, that is blow your mind kind of numbers. Earnings per share over 10 years is a compounded annual earnings is slightly behind. Now, Disney is a more established, more stable company because of the parks business. It has a higher market cap than Netflix as well. And it's managed to grow earnings because it's a more mature company. It feeds the earnings through in a more sustainable way. Netflix being a growth company, they spend to get more subscribers. And a lot of those earnings are taken up in the spending. Same kind of story with Amazon. Amazon will spend to make sure that it doesn't have too much earnings because it's all about the growth in the business. Whereas Disney's taken a slightly different tack because it's a slightly more established business, a little bit more conservatively run business. Now, the point that I'm making is like Disney has now seen how Netflix is doing this. So yes, Netflix has first mover advantage, but the difference is in this case, it almost doesn't. Because what Netflix is, it has is a digital subscription model where you go, I mean, you all guys know how Netflix works. You go and you subscribe for however many bucks a month, and you can watch all this content. But the real competitive advantage, the moat around each of these companies, the thing that makes, okay, I've put Amazon Prime Video as another comparison, is the thing that makes this unique is really the type of content that it can deliver. Now, Netflix in the past could deliver Disney's content. Now, remember what Disney is. Disney is Hulu, Disney is Pixar, Disney is Star Wars, Disney is Marvel, Disney is ESPN, and of course, all the kiddie content around Disney as well. That's Disney's content library. That content library was available to Netflix through a revenue sharing agreement where Netflix would pay Disney to use its studios and its content on the Netflix platform. Now, Disney has said, wait a minute, what are you actually providing Netflix in terms of value? Great, you've got an audience and people have Netflix subscriptions. But people can just cancel the Netflix subscription and subscribe to something else as simply as saying, click the cancel button and load their credit card details into a different online streaming site. It's very, very simple to switch platform. The platform isn't the moat. The moat around the company is the content. If you have Marvel and Avengers and all of this like historic content, and you have Aladdin and all this, that's where the safety is, and that's where the potential is in the company. Netflix realizes that, and that's why there's a huge spend in Netflix, why they can't deliver the earnings, because they've got to be spending all that revenue, that huge revenue growth that they've got has to go into basically creating new content. And that's where you get the Netflix originals, where they're trying to build up their library of high quality content. Now, the problem is that, Disney, established player, they've got a long history of content. Like I said, they've got so many well-loved franchises that if they are to distribute via a Disney Plus, which is their streaming service, I think that they're going to be able to take Netflix subscribers. Yeah, people might have both, but I think that they're going to offer a better quality service, and that's why we would prefer them. So over the last year, Disney's done about 100% dollars over the last 5 years at least, about 100% in dollar terms, in terms of share price total return. Netflix has done almost 400%. So Netflix over the last 5 years was the place to be, 100% guaranteed. But remember, Disney only launched its streaming service, I think, towards the end of 2017. Already they have, I think they've got just over 100 million subscribers compared to, I've got this written down somewhere. I think they've got about 100 million subscribers to Netflix's about 200 million subscribers. So they've grown incredibly quickly. They've grown far more quickly than Netflix because they have a much wider audience and they've got a much more recognizable brand. Now, Amazon's in there. Now, a different story about Amazon. Remember Nike. There's something to having a brand, and it's why we own Nike as well. Nike was being sold on Amazon, and Amazon's obviously got the issue with fake content and all of that. But when Nike decided, they said, but wait, we've got the brand, we've got the recognizability. All you're providing us, Amazon, is a different shop front. We can have an online marketplace. That's not difficult to build. We can download one of those for free. We can build it on a WordPress site if we want to. It's really simple to do that. What's really difficult and what the moat is our brand, Nike. And on top of when we put Nike on Amazon, one, yes, you distribute, and it's great that we get some extra sales. But at the same time, fake Nikes can be sold from all the Amazon partners, and people can't tell the difference. So Nike said, you know what? We're pulling out of Amazon. You cannot buy Nike products on Amazon. You must buy them through Nike. So they cut Amazon off, and Amazon is now looking at it going, those super popular brands can do that. It's exactly what Netflix has just done, what Disney at least has just done to Netflix. Now that degrades Netflix's platform, it degrades Amazon's platform not to be able to buy Nike products on Amazon, because the most popular brands will never be available on Amazon because they can distribute themselves. And it all comes down to the competition around the logistics, which you can go and get a FedEx or someone else. I believe that can easily be done in isolation. It doesn't have to be part of the conglomerate as it is with Amazon. So that's kind of why I think there's, if I had to bet Netflix versus Disney over the next 5 years, based on whose streaming business is going to win, given the content library and given the experience in making high quality content, and given Disney's bigger market cap and budget than Netflix, I think you're going to see Disney producing better content, getting subscribers, and eventually you might see Netflix go the way of blockbusters. I'm not saying it's going to, but for me, that's why I prefer Disney over Netflix. No reason you can't own both, but for me, I own Disney over Netflix. Now, why is Amazon Prime Video in there? We do own Amazon, and I like Amazon as well, because the one thing that Netflix isn't getting right compared to Disney and Amazon is that a lot of the content that is created is actually to generate audience. And what Amazon is doing is the typical Jeff Bezos model, which is it's going to create this product and it's going to basically give it all to you for free. So Amazon Prime. So Amazon Prime is incredible. So Prime Video is part of Amazon Prime. Now, Amazon Prime, if you don't know what Amazon Prime is, it's essentially, you pay, I think it's $119 a month for a subscription, and you get free delivery, you get free videos, you get like basically you're in on the Amazon community. Your Kindle books are cheaper, and you get free Audible stuff, and it's just you go into the Amazon ecosystem and they look after you. So JP Morgan analyst did a little review of Amazon Prime and said, for $119, how much value do you get? And they equate the value that a person gets if you had to buy all the things that you get separately at about almost, it's $785. So it's almost $800 worth of value for $119 subscription. And Amazon sees it as a loss leader. So why do they do that? They do this because in Amazon Prime, someone that has bought a subscription to Amazon Prime so that they can go and watch Amazon Prime Video is twice as likely to spend on the Amazon platform as a non-Amazon Prime subscriber, because they get free delivery and all of that. And Amazon, which is also, it's big news this month that they just bought MGM Studios for, they bought it for, it was $8.45 billion, which is tiny because Amazon's market cap is $1.65 trillion. So it's very small for Amazon, but Amazon is not an acquisitive company at least. So it's it is important. The biggest purchase Amazon had done before the MGM was Whole Foods in I think it was 2017 for $14 billion. So, this is a big purchase. This is a purchase. It's not big in the context of Amazon's overall share price, but why is Amazon buying this? And it's because, okay, they get James Bond, they get Rocky. They don't get great, unless you're a huge James Bond fan, you might shoot me down for that. But it's in my opinion not great content, but what they get is the ability to create. They're bringing in expertise because they see that they're behind in the streaming wars, and Netflix is currently ahead, but I think Disney in operational ability is actually number one, and they want to catch up quickly. Now, what Amazon has that Netflix doesn't have, and neither does Disney, is the budget. If Amazon wants to go and spend, a couple of billion on a movie, they can just do it, no problem. Why are they doing it? They can do that movie and run it at a loss, exactly like Jeff Bezos built the entire business, so long as it increases their sales and their retail arm. It's a story about I don't know if you've watched, it's actually a Netflix documentary, a documentary on He-Man, which was my childhood cartoon. That whole cartoon, the He-Man cartoon that kids loved when they were growing up in my generation, was actually created purely to sell the action figures. The action figures was where all the margin was. Like they literally, a marketing team sat around and said, we've got these action figures we need to sell. How can we market them? And they said, let's create a show. And I think that's the thing that Netflix is going to miss out on in the next 5 years. They don't have the ability to get, they don't have that kind of integrated arm to monetize their audience. They're monetizing the audience only through subscriptions, and I'm assuming revenue share models as well. But for me, to keep the downstream benefits in house, I think is very different from a logistics division. Put it that way. I think when you can kind of push your own products through your own channel, I think it's going to be great. So that's it. So out of the three, I'm saying buy Disney. It's been the laggard over the last little bit, but it's been more conservative. It's had better earnings profile than both the other two, but hasn't been able to grow the revenue because it's a more conservative business. But for me, definitely, Disney is something to put in the portfolios. If you're looking at the technical stuff, I've got a chart up here. It's run hard. So I'm saying it's a stock pick, but it's not an immediate stock pick. I think you've got that kind of resistance line. I would probably be buying closer to, I'd say, the $165 level. That's where you're going to buy it. But remember, if you look at analyst forecasts at the moment, it's probably too small for you guys to see. But the median estimated 12-month share price of Disney is $207.32 per share. So that's significantly high. It's about 18% higher than where we are now. So if you're looking for companies that are going to outperform, even buying here, which I think is high, just as an execution, you still should see 18% upside given median analyst targets. Of course, it can do more, it can do less. I mean, this is what equities are all about. But I think if you're buying at 165, I think it's a great price. I think it's something that's definitely worth adding to anyone's portfolio currently. So that's kind of the stock pick for the day. And I'm running out of time. It's 7 minutes to do everything now. So sorry about that. Okay, so this is commodities. So interestingly, everyone's talking about the commodity super cycle and booming, and what do they say? Stocks aren't cheap and popular at the same time. I get the sense that commodities are really expensive. So I'll answer the gold question and the platinum question at the moment. So Neil Froneman, who's what a legend! He's such an amazing operator in the South African market. He's the CEO of Sibanye-Stillwater. I really love the way that he's turned that company around. And I mean, he says we're going into a commodity super cycle. In my opinion, we're not. And why can I say that and have any credibility next to someone like Neil Froneman? Because I think, yes, we will, but it depends on the commodity. As you can see, there's many different kinds of commodities. I've got corn commodities and all the different corn contracts. We've got lumber, we've got all the different softs in there, sugar and rice, and we've got cotton futures, we've got lumber futures. I mean, I've got 2 lumber futures in there. I had more space. Do this one quickly for this month. You've got oil, you've got lots of different types of commodities. Now, are we just going into a commodity super cycle? That's a very broad term. What is a commodity super cycle? So looking at commodity super cycles historically, there has to be something that's going to drive it. The last one was driven by essentially the modernization of China. They lost 10 years. Like, okay, so let me answer the golden pattern question. Where does a commodity get its value from? That's the question I want to ask you. A commodity gets its value only from supply and demand. A business doesn't get its value from supply and demand. Buying Amazon shares or Disney shares, it's a business that has a management team that goes out, that performs an operation constantly to generate a profit margin that's paid to you as a dividend or returned to you through share price appreciation when they do a share buyback. A company earns money. If they're not earning money, they sell off their rubbish and they focus on stuff they do. The business changes as the world changes. Disney goes, hey, Netflix is making a lot of money in streaming. We can do that better. They create a streaming division. And that creates that compound annual growth. You don't get compound annual growth in commodity prices. Why? Because commodity prices, they are purely determined by scarcity. So when you have a massively growing population and you build in lots of houses, you build in railroads, and your population is expanding, commodity prices go berserk. And that's where commodity super cycles come from, where you're literally your means of supplying the commodity, the supply is always lagging demand because there's more and more demand as there's more and more people. That's a different world that we're living in from today. China also this month said that they would go to a 3-child policy because they've got negative population demographics. We're chatting about this in the investment committee on Thursday. The problem with the 3-child policy is that you've had a 1-child policy, and now these people are already looking after their aging parents. Now they're looking, can I afford to have 3 kids? Of course they can't afford to have 3 kids. So we don't see this changing the demographics of China. China is going to have an aging population. Most of the developed world is operating below replacement value. It's only really places like even southern India is coming down in terms of birth rates. So it's northern India and it's Africa. That's where the population boom is going to come from, and that can create a commodity super cycle. But hey, like, is that going to happen? I don't know. Maybe if in Africa industrializes, but hey, it might not. And the problem for me is that the idea that we're going to get a super cycle in oil, I don't think we're going to get a super cycle in oil. We're going to move to an electric vehicle. We can't keep pumping oil. It's just regulation and the whole move towards green energy is going to change that. Will you get it in lithium and cobalt because they're battery producers? Absolutely possible. That there might not be enough production, and we'll be sinking mine shafts, which are long-term projects, and we're not going to be able to match the need that the electric vehicle industry has. Those commodities absolutely goes into a super cycle, but a broad-based commodity super cycle, I don't think so. Soft's going to be in a commodity super cycle. Are food prices just going to continue to inflate? I believe that capitalism will take care of it. If Moderna can make a coronavirus vaccine in 3 days, why we as humans are smart enough to continue to make genetically modified food to feed the population, even if it was growing. We have enough land to do this. So for me, the idea of a decade-long rise in soft commodity prices like wheat and sugar and corn, I don't believe that will happen. I believe volatility is the order of the day. That's kind of my view on that. So gold, okay, so to answer the question of gold, which was, let me just read it again. Sorry, I joined late. Gold, opinion on gold and platinum. If you covered it in the first one, let me know. I'll look at this in the recording. Okay, so now I haven't, so gold, for me, I like gold because I believe, okay, everyone needs an emergency fund and everyone needs a go bag, in my opinion. I think you should always have something that you always have to have something liquid, something you can put in your pocket and run away with. So that's what you should have your gold for. It's an alternative asset class that is fun to own. You can own it via Kruger's, buy it through this exchange. We can deliver Kruger rands to you if you want to buy them. Buying gold ETFs long-term, gold is fun to trade. It moves as well. But like as a long-term investment, I don't think gold. You probably will get the inflation aspect of it, but its entire supply is driven by sentiment. It's driven by supply and demand. It's been around for a lot longer than Bitcoin, but if you're only relying on scarcity to create your return, I think you're going to be disappointed. That said, I absolutely love to have gold in a portfolio because it's a great hedge. It is very uncorrelated to general market movements because it's just based on whether people want to buy and sell it. And I own gold as well, so I can't really say that like I hate gold because I do own gold. But like I said, I own it as kind of like as a hedge, as a safety thing, and as something to literally have physical, grab it if you're on the run and it's a zombie apocalypse. That's what you have gold for. As a significant portion of a large investment portfolio, if you've got a 50, 60 million rand, 100 million rand investment portfolio, will it be putting 10 million rand into gold? Probably not. I'd probably downweight that even to like 3-4%. Maybe upweight if you've got a very small portfolio. You could have a larger gold component, but gold, in my opinion, should just over a long period of time, we'll just track inflation. It's not. Yeah, it depends how you measure things. If you believe like the Bitcoin guys that fiat is all rubbish and going to zero, well then you should probably hold some gold and probably Bitcoin. But I don't know. I kind of follow Andrew Bailey, who's the governor of the Central Bank of the UK, the Bank of England. Says he's going to reiterate and be blunt. There's no intrinsic value to a cryptocurrency, and anyone who invests in them must be prepared to see their money go to zero. So now you can throw the tomatoes, all the crypto people. But yeah, commodities. Well, the one thing that we are seeing is we have to wrap up the rest really quick. Commodities are flattening out. So I'm just going to go over by like 10 minutes maybe, if you guys want. So currency, so this is the currency chart. I put my neck on the block last week. I said, this is a great time to take money overseas. I said, currency markets generally make you look like an idiot whenever you try and predict them. And it's done exactly that. So last month, the median prediction from the big banks, the smart prediction was 15.30. That's on a 12-month view. The current price was around 14.20. I said, hey guys, when it gets to 14, that looks like a good buy. We're currently 13.62. So maybe a great buy, but I've been totally wrong on the currency. And it was also pointed out in our investment committee meeting that, historically, like if you go back to, and we've got guys that obviously, we were kind of talking about 2008 and what happened to the currency after that. And if you go look, I don't have a long-term chart of the currency up at the moment, but if you look at the long-term chart of the currency, it's, how can I put it? It can stay strong for a long time as well. So I think just maybe be cautious, but I don't know. I still see weaker currency. But like I said, that's probably like an internal bias of mine. But I still see it. I see this as a great level to go out. I'm still short currency as well. You can see the big banks have been wrong-footed as well. So a lot of the estimates have come down in a big way. Goldman Sachs was at 1380. They haven't changed their call. Julius Baer is still at 1550. That's a new call from them. Morgan Stanley, they haven't changed their call, but everyone else, RMB, Investec, Nedbank, Wells Fargo, Absa Capital, all of them, big drops from last month. This is their published poll that they put out once a month. It was put out yesterday. So these numbers are very, very fresh. So the banks obviously looking at the currency and saying, 12 months out, we can't see it getting too much stronger from there. So on a technical basis, we've got this little downtrend, little strengthening trend in place, weaker US dollar. It's kind of broken out of that. You could go all the way back to, I don't know if that is the bottom of the channel. The channel might be a little bit higher up, but there's this kind of short-term slump in the currency. And short of a big risk-off event, is there any reason that the rand would get that much stronger? So get that much weaker? You can always leave it to our politicians to do something crazy, but it's strong. It's very strong. That said, taking funds out now, the currency is not where you should be getting your performance from. You should be getting your performance from underlying assets. So speaking of underlying assets, let's quickly look. I'm going to run through this one really quick. Managed portfolio. We continue to do great, and this is what. Here's the chat. Thanks for a great session. Always really enjoyed the NAS and Netflix and Disney. Okay, thanks. Thanks, Raina. So this is the so there's a quick rundown of the managed portfolio. We were positive last month. I think we put on about 0.5% in dollars, which is great. We're still sitting a little bit heavy in cash. We're still looking for just a little correction to deploy into. I still like the idea of moving more towards Europe. Still very happy with our companies. Yeah, so just to give you a view of the longer term, that and I thought I'll put this up as well. So even with the stronger currency, so we had 13, okay, call it 1362 when I did the numbers this morning. We've still done, in dollar terms, over the last 5 years, we've done 102% performance on our fund. If you had invested in the top 40, even with the stronger currency, everything translated back, the equivalent is you would have done 30% there. So we're more than 3 times ahead of the local market by being offshore. So we're still comfortable with that. If the rand does blow out, of course, that's going to add a tailwind. But if you're looking at currency as the way to think about your offshore investment, you're doing it wrong. Because especially if you've got a 5-year view and you're in this for the long term, which you should be if you're in equities, all of you guys that have invested in the fund so far, you know my view. Stick in there. This is a long-term thing. It's what I do for my family. It's what I do for me. It's a long-term position to generate wealth over a long period of time. And that's what we're doing. And that's and you know, where the currency is going to be in 5 years is still anyone's guess. But if it's a lot weaker, at times it's going to look fantastic. And when you're looking at it at times like this, it's going to look very difficult because the currency is a lot stronger. But it depends on your time horizon as well. But even with the strong currency, we've way outperformed local markets. Obviously, we went through the coronavirus crash there. 2018 was also a little bit tough. But in general, we've had very, very stable upward performance. We're up 10% in dollars for the year. So very, very happy with the way things are running. Yeah, so that's just us versus, we actually benchmark against the MSCI World, even though we've got such a heavy US focus. We might have to actually switch the benchmark at some point because with the launch of these European and the UK portfolios that we launch in this month, just because this might become a more US focused portfolio, so that it doesn't encroach and cannibalize your clients that want to go into our European and our UK portfolios. But yeah, we can see massive outperformance during the coronavirus. We've had 3 months of nice outperformance. We underperformed the MSCI World slightly. That was largely because of how strong the emerging markets were compared to the developed markets. As I said, if we were benchmarking against S&P 500, we were way ahead for this month. S&P 500 was or at least the US markets, including the broader measure of the market, was heavily on the back foot. Yeah, so you can see outperform, and then outperform, okay, slight underperform, outperform, and we're slightly behind this month. But also, as I said, long-term portfolio, still very happy with the strategy that we were deploying, and we'll deploy the last little bit of that capital. Hopefully in the sell in May, go away, little correction that we get now. If you are, okay, our investment philosophy, most of you guys, I saw a lot of guys that are in the presentation today are clients. Our philosophy is really simple. We stick to really good quality companies. We're not here, we're sticking to Disney's over super speculative Netflixes, if you want to put it that way. We like established companies with great management teams. We don't mind paying up for them if we have to, but we rely heavily on quantitative and third-party analysis. Especially we've got a model that works off consensus. We've got a whole lot of it's a multi-factor model, and it's done really well. We've outperformed 4 out of the last 5 years. We're a little bit behind actually this year, but I'm pretty certain that if we get a good deployment, we'll be beating the market again this year. So yeah, comfortable with what we're doing. Really happy so far. All the clients have always given us very positive feedback because we've made them a lot of money. And that's it. It's obviously considered high risk because the portfolio is 100% equity. It's up to you to speak to a wealth manager, dial up your equity, dial down your equity. That's a broader discussion that's specific to you. I'm talking specifically from the point of view of managing equities and managing these equities specifically. If you want to get involved, we manage on a couple of different platforms. 1362 seems like a good rate to me, but what do I know? You can do it through Saxo Bank, Swissquote. Swissquote is our Swiss banking partner. Really cool there. They've got a whole lot of new stuff that we can chat about, but I'm out of time, so I'm over, so I won't tell you about that. But yeah, if you want an account, go to our website, randswiss.com/account. You can sign up there, and that's the presentation for today. Thank you very much, everyone. Had to rush the end a little bit, but yeah. Any other questions before we sign off for the day? Nope, nothing. All good. Cool. I'm going to leave it at that. And thank you very much for coming. Yeah, like I said, look out for that email on the PMC accounts, because they're really it's a, in my, like, if you can find a better rate on a call account for call cash, please let me know, because we'll go and do a deal with that person. But at the moment, this does look like the best account in the market. So cool. Thank you very much, and everyone enjoy the weekend, and stay warm and stay safe because of coronavirus.